All right, let's get right into it. The rules of the game are changing for every single creator, freelancer, and side hustler out there. For years, many people skated by without getting that dreaded tax form from PayPal or Etsy. But those days are officially numbered. The IRS has been trying to lower the reporting threshold for Form 1099-K for a while now, and they're finally making big moves. For the 2025 tax year, which you'll file in 2026, the threshold is dropping. It's not going all the way down to the $600 they originally wanted, at least not yet. Instead, they've set a new temporary limit of $5,000 for the 2024 tax year and have announced a target of just $600 for 2025. This is a massive shift from the old rule of $20,000 in payments and over 200 transactions. It's a wake-up call. This isn't just some minor administrative change, it's a fundamental shift in how your income gets tracked. Previously, you could have earned $19,000 through a payment platform, and as long as you had fewer than 200 transactions, that platform wasn't required to send you or the IRS a 1099-K. Let's demystify this form that's causing so much buzz. A Form 1099-K payment card and third-party network transactions is simply an informational document. It's not a bill. All it does is report the gross amount of payments you received through a third-party payment network during the year. Companies like PayPal, Stripe, Etsy, and even Cash App are required to send one copy to you and another copy directly to the IRS once you hit the reporting threshold. The most important thing to understand is that the 1099-K threshold is not an income threshold for when you have to pay taxes. This is where so many people get confused. You are legally required to report all income you earn, from the very first dollar, whether you receive a tax form for it or not. So if you earned $599 on Etsy in 2025, Etsy won't send you a 1099-K, but you are still legally obligated to report that $599 as income on your tax return. Another critical point is that the amount on your 1099-K is the gross transaction amount. This is a huge deal. It doesn't account for any of your expenses, fees, or refunds. It's your job and your job alone to track all of your business expenses like software, equipment, marketing costs, and platform fees to reduce your taxable income. So don't panic when you see that form. It's just data. The real work lies in your own record keeping. Let's make this crystal clear with a few real-world scenarios that you might actually encounter. Imagine you're an Etsy seller who makes beautiful handcrafted jewelry. Throughout 2025, you have a great year, and your total sales processed through Etsy payments amount to $5,200. Because this is over the planned $600 threshold, Etsy will automatically generate a Form 1099-K and send it to you and the IRS in January 2026. However, you know that you spent $800 on beads and silver, $300 on Etsy listing fees and marketing, and another $400 on shipping supplies. You must track these expenses to deduct them, reducing your taxable income from $5,200 down to a much more manageable $3,700. Without tracking, you'd pay taxes on the full amount. Now, let's switch gears to a YouTuber. You have a growing channel, and in 2025, your AdSense revenue finally starts taking off. Google pays you a total of $1,200 for the year directly to your bank account via their payment system. To produce your videos, you bought a new camera for $700, a subscription to video editing software for $240, and some stock music for $60. These are all legitimate business expenses. By deducting them, your taxable income from YouTube drops from $1,200 to just $200 for the year. That's a massive difference. Consider a freelance graphic designer who uses PayPal to bill clients. In 2025, you work with 3 different clients. One pays you $300, another pays you $250, and a third pays you $400 for a big project. Finally, let's talk about someone who uses multiple platforms. In this scenario, none of the individual platforms paid you over the $600 threshold. Therefore, you likely won't receive a 1099-K. Does that mean you don't owe tax? Absolutely not. All income is taxable, period. Now for the exciting part, how to legally shield your income from taxes. As a self-employed creator, you have access to some of the most powerful retirement accounts that exist, namely the Solo 401k and the SEP IRA. These aren't your standard workplace 401ks. They are supercharged versions designed specifically for business owners, even if your business is just you. Choosing the right one can save you thousands or even tens of thousands of dollars on your tax bill each year. Let's start with the SEP IRA, which stands for Simplified Employee Pension. As the name implies, it's incredibly simple to set up and maintain. You can open one at most major brokerages in about 15 minutes. The beauty of the SEP IRA is its high contribution limit. You can contribute up to 25% of your net adjusted self-employment income, not to exceed a certain limit set by the IRS each year. This makes it a fantastic, straightforward option for creators who want an easy way to save a significant chunk of their income for retirement and get a nice tax deduction without a lot of administrative hassle. It's a set-it-and-forget-it kind of plan. On the other side, we have the Solo 401k. This account is a bit more complex to set up but offers incredible flexibility and power that the SEP IRA just can't match. With a Solo 401k, you act as both the employee and the employer, which means you can make contributions in both roles. The Solo 401k has another massive advantage: the option to make Roth contributions. This dual contribution structure often allows you to contribute more money at lower income levels compared to a SEP IRA. So understanding the contribution limits is key to maximizing these accounts. The IRS adjusts these limits for inflation, so it's important to stay updated. For 2025, let's look at the projected numbers. For a Solo 401k, you have two parts. The employee contribution limit for 2025 is set at $23,000, plus catch-up contributions if you're 50 or older. Then comes the employer contribution. This is calculated the same way for both the Solo 401k and the SEP IRA. You can contribute up to 25% of your net adjusted self-employment income. Let's put this into practice. Imagine a creator earns $80,000 in net self-employment income. With a SEP IRA, they could contribute roughly 20% of that, which would be about $16,000. Now let's see what they could do with a Solo 401k. As the employee, they could contribute the full $23,000. As the employer, they could contribute the same $16,000. Their total contribution would be $39,000. That's more than double what they could put into a SEP IRA, resulting in a much larger tax deduction. One of the best features of the Solo 401k is the choice between traditional and Roth contributions for your employee deferral. This is a crucial decision that hinges on one simple question: do you think your tax rate will be higher now or in the future when you retire? It's a bit of a bet on your future success and the direction of future tax laws, but we can make an educated guess. A traditional Solo 401k contribution is made with pre-tax dollars. When you contribute, say, $10,000, you get to deduct that full $10,000 from your income for the current year. This immediately lowers your tax bill. A Roth Solo 401k contribution works in the exact opposite way. The money you contribute is post-tax, meaning you get no upfront tax deduction. This might seem like a bad deal at first, but here's the magic. That money grows completely tax-free, and when you take it out in retirement, every single penny, the contributions and all the incredible compound growth, is 100% tax-free. This is an unbelievably powerful tool for creators who are just starting out, are currently in a lower tax bracket, and expect their income and tax bracket to be much higher in the future. You're essentially paying taxes on the seed, not the harvest. So how do you choose? A simple rule of thumb: if you're a young creator or your side hustle is just taking off, and your income puts you in the 12 or 22% tax bracket, the Roth option is likely your best bet. You're locking in that lower tax rate forever. If you're an established high-income creator in the 32% bracket or higher, the immediate tax deduction from a traditional contribution might be more valuable. Some people even like to hedge their bets by contributing to both, creating a mix of taxable and tax-free income streams for the future. The best retirement plan isn't a one-size-fits-all solution. It depends entirely on your specific situation as a creator, your income level, your goals, and whether your creative work is a part-time side hustle or your full-time career. All play a massive role in determining the right path. Let's create a simple blueprint to help you decide. We can break it down into two main profiles: the part-time side hustler and the full-time creator. Let's start with the part-time side hustler. This is someone who has a primary W-2 job that likely offers a workplace retirement plan like a 401k, and their creative work is a secondary income source. For this person, a SEP IRA is often an excellent and simple choice. Why? because they are likely already contributing to their workplace 401k as an employee. Their side hustle income provides a perfect opportunity to open a SEP IRA and contribute up to 20% of their net creator earnings. This gives them a great tax deduction on their side hustle profits without the complexity of managing a solo 401k on top of their day job's plan. It's clean, easy, and effective. Now, let's look at the full-time creator. For anyone whose primary or sole source of income comes from their self-employment, the solo 401k is almost always the superior vehicle. The ability to contribute as both the employee and employer allows for much higher contribution amounts, which means a bigger tax deduction and a faster path to a secure retirement. If you're a full-time creator making $100,000 a year, the solo 401k allows you to save significantly more than a SEP IRA would, which is critical when this is your only retirement savings tool. Congress passed a major piece of legislation called the Secure 2.0 Act, and it has some incredible provisions that directly benefit self-employed creators. Ignoring these updates is like leaving free money on the table. One of the most significant changes involves catch-up contributions. For years, people aged 50 and older could contribute an extra amount to their retirement plans. For 2025, that standard catch-up contribution for a 401k is $7,500, but Secure 2.0 added a new, even more powerful twist. Starting in 2025, there is a second tier of catch-up contributions for individuals aged 60, 61, 62, and 63. During this 4-year window, the catch-up contribution limit increases to the greater of $10,000 or 150% of the regular catch-up amount. This is a massive targeted opportunity for those approaching retirement to make a final aggressive push in their savings. It's a clear signal from the government encouraging people to bolster their nest eggs. If you fall into this age range, leveraging this provision through your solo 401k is an absolute must. Another critical takeaway from the new rules is the importance of opening your plan early. For a solo 401k, you must establish the plan by December 31st of the tax year in which you want to make contributions. You can't wait until April 14th of the next year and decide to open a plan for the prior year. Don't procrastinate on this. It's a hard deadline that, if missed, will cost you an entire year's worth of tax deductions and savings. Finally, let's talk about automating your tax payments. As a self-employed creator, you're responsible for paying estimated taxes throughout the year, typically on a quarterly basis. The best way to handle this is to automate it. Every time you get paid, set aside a percentage, 20 to 30% is a safe starting point, into a separate high-yield savings account specifically for taxes. Automating this process removes the stress and ensures you're always on top of your obligations, letting you focus on what you do best. Creating. Getting started with a SEP IRA or a solo 401k is easier than you think. You don't need a fancy financial advisor. The key is to choose a low-cost, reputable brokerage like Fidelity, Charles Schwab, or Vanguard. Opening an account is a straightforward online process, giving you access to a wide range of low-cost index funds and ETFs. Once your account is open, automate your contributions. For tracking income and expenses, a simple spreadsheet or an app like QuickBooks Self-Employed is all you need. The specific tool is less important than the habit of using it consistently. This discipline is what pays off. We've covered how new 1099K rules will impact creators and the retirement strategies you can use to build wealth. But knowledge is only power when you act on it. The creators who proactively organize their finances will thrive. This isn't about sketchy loopholes, it's about using the legal tax incentives available to small business owners. Your task today is to make a decision. Take control. Open that retirement account. Create that expense tracking spreadsheet. The deadline to establish a solo 401k for 2025 is December 31st, 2025, and time will fly. To help you get started, tell me in the comments what kind of creative work you do, and if it's a side hustle or your full-time job. I'll reply with a suggestion on which retirement plan might be a good fit for you to research. Let's build a community of financially savvy creators. I'll see you there.